Hi, everybody. I'm lucky enough to be joined by Jack Oineza, financial planner from Ryker Capital. Jack, thanks for joining me.
Hey, thanks, Jack. Time flies, buddy.
It's been a while.
How nice is that? I think, talking about end of financial year, everybody talks about it.
Hmm.
Here's budget, property, and all that. Now we're in July. Jeez.
Yeah, yeah. I can't believe it's the middle of the year, let alone in the financial year. But no, it's a lot happening over the last couple of months. And, I'd love to ask you a couple of questions about it, especially. Being in the property field, maybe selfishly, I wanted to understand a little bit more around how appropriate property is now as an investment, considering, especially on existing builds and in SMSF as well, that there are a little bit more difficulties being, no longer being able to negative gear property when you purchase it, only having negative gearing on grandfathered property or on newly developed property. How appropriate is property as an investment, I guess, now that we don't have access to negative gearing or new investors don't have access to negative gearing?
I've actually been having a discussion with this with clients and as well mortgage brokers actually just trying to navigate what's out there because there's a lot of noise, a
Mm.
lot of uneducated opinions and things of that nature, which is great information, You get the hold of it and people try to understand it or unpack it and they go say, too hard, I'm just going to sit tight. So circling back to your question, how relevant or how important is still an asset? Absolutely, my property is still a great asset to invest in. Done correctly, with the right advice, the right structure, the right numbers in place, right? Yes, it poses a challenge in terms of what the government's done, or not done, I should say, in some cases. But as a whole, as an asset, I believe it's still a great asset to invest in. You just have to get the right guidance and how that relates to you as an asset overall. I call it as an asset as a tool, as you know.
Mm.
Well, I don't really care if it's resi, industrial, commercial. If it's a prop investment, I'll look at it and see how that benefits or impact on it. At the end of
Yeah.
the day, heavily still is good asset.
Yeah, I think that's the case, especially, cash flow was always an important part of purchasing property. And now that those negative gearing incentives or benefits aren't there to protect you, it's even more important now, I guess, if anything. Uh,
The plan, sorry, just did one just to make because I've had a lot of plans before the budget changes.
mm,
So I had to pivot, see what that looks like with negative gearing or not. In some cases, between the found the plans I've done, with or without negative gearing, there's a difference of about $5,000 to $9,000 gap.
yeah.
Not much. And if I
Mm,
told the client, can you afford that with or without negative gearing? 8 out of 10 clients say, yes, I can afford it.
mm,
If I put it in with their buffer as a cash flow, hence going back to that, how is that? Because you have to calculate tax, you have to calculate income, cash flow the property. Yes, obviously I want to save tax. I do.
mhm. Yeah.
But you have to look at the aspects around it as well. So if you explain it that way, it's get clarity. It's okay.
Yeah. Look,
The gear is, I always say, if you can buy existing or price of July next year, existing versus new, not going anyway. It's just deferred. So it's all good.
yeah. No, 100%. I think cash flow assessment is such an important aspect of purchasing property because, it's not about, purchasing a physical asset. It's about, well, how long can you afford to hold it? And can you afford to hold it for the long term? Because typically that's where we see the returns. So what part of the cash flow does go into the client's financial plan?
You're a big believer of that cash flow. It's not in isolation of asset. You have to
Mm,
look from behind it. So critically important. It's the analogy of, your lifestyle's this. If you take it on this, what would it look like? Is there any compromise you need to make to take on this particular asset? I call it asset or property in
yeah.
this, what would that look like? So again, having that conversation up front eliminates any unnecessary decision making or hesitation at some stage.
Mm,
So what tends to happen when I engage the mortgage broker buys H in your case, they pretty much understood the whole cycle already and they're comfortable. So
Yeah.
yeah, absolutely important.
What about informing a part of a client's portfolio? I mean, I always tell people that, purchasing direct property is a good way to get away from paper assets and, diversify into direct assets, because property is probably one of the only few direct physical assets that generates capital growth and rental yield, or an income yield rather. And I don't think off the top of my head that there are any other physical assets like gold doesn't generate an income, or art, or any other rare material. So how does that form in terms of diversification and formulating a client's overall portfolio?
It's critically important. Again, it comes back to what they come with after we explain it. I mean, your word, you said physical asset, that tangible rental yields and things of that nature. So, in a world of the financial advice, we get alternative asset, but it's not physical in the sense of the rental yield. So, on the commercial property, how do you then, make that to life as an example in comparison to other diverse assets to make outcome? So, yes, it's a bit of balance to educate for what that could like for a particular client. And, you work around it and it diverse. Okay, well, if we're going to invest, say, 80% of the asset into direct bricks and mortars, what do we do to the rest? We'll partner that with other things as well. So, SMSF lending side, or before lending was disappearing, even now, you gear up, or the LVR I do is about 60 to 50% to work. So then goes back to diversification. If you're only putting 50%, what do you do with the rest? So yeah, it's a bit of balance.
Yeah. Yeah, and I think you raised a good point. Like, how big a part of your overall portfolio does it play? Like, are you comfortable with that amount as well? And then the LVR goes into play as well. Like, yes, you have a $600,000 property, and your portfolio is $1 million, 2 million, whatever it is. So as a total proportion, but because you're putting lending into play, you've almost magnified that risk essentially. How do you factor that into the conversation around, okay, well, you're buying a physical asset, you're, 30, 40% of your portfolio, but it's also geared because of lending. Like, how do you incorporate that into the conversation?
Where you start up again, whether it's inside or outside super, the bare basics, the bare bones of it is really the cash flows out of it. I know it sounds boring, but it comes back to that at the end of the day. Is it going to be sustainable if we do the 60% landlord or 50% LVR? What does that look like? So if we watch it, you kind of show that to the clients and let them decide and say, well, hey, if we do the 65% LVR, whereas the 50%, this is the outcome, the potential outcome. Are you going to be comfortable with this? This is the risk we're going to be facing with, because if we take on more risk on the lending side versus to like diversify on the other side of the end. So it's like a lever, I guess. We gotta do this and match it with that. So yeah.
Yeah, no, fair enough. I completely understand. And then one of the more recent changes as well was, speaking of self-managed super fund, is, no longer able to borrow, well, unless you're under contract before the 10th of August, no longer being able to borrow to purchase inside your self-managed super fund. So should people be rushing in to buy property just for the sake of it within their self-managed super fund? Or would you urge people to be a little bit more cautious?
Yeah, it's a tricky one, Johnny. Because when there's I wouldn't say fear, probably the word fear from like FOMO, I guess.
Yeah.
That FOMO can be good sometimes, you see. But more often than not, it is not. Because your senses are heightened and you kind of, we're not doing any analytics around it. You might have done analytics or analysis before, and suddenly that's being speed up because of that there's a deadline. It might could be very, very detrimental, right? Especially if there's no advice process in that piece. So I have had discussions around that. I've actually turned away too in the last 2 weeks since the thing. Mortgage brokers said, can you do this? Because, settlements, all that stuff, they need advice, blah, blah, blah. And they found and all that stuff. And unfortunately, you have to politely say, like, I'm not going to be able to do it during that short period of time to do the advice.
Oh.
So the disadvantage is that they're not going to get the advice. They might just go to the pre-approval and get the property. The advantage of waiting is obviously, well, they might miss out on the opportunity as well. So it's a case-to-case basis. It's a tough one. It's a very tough one because there's a lot of things out there at the moment that's promoting it, or at least promotion, I guess. Let's call it what it is, to keep the deadline at 10th of August to get your lending done or back properly, So be careful, I would say, and get the right advice as well, even though you're in the mix already, right? I've got one that's come from a mortgage broker. Before the change happened, they're already in the process. But the thing is, they realize, hold on, I'm going to get some advice, see what this all looks like for me, whilst they've established it already. So they just wanted to see what it looked like. So, again, it's a tough one.
Yeah. I think if you're in flight already, I think, you've got your relatively good time frame. But like I've got people coming to me in the last day or two, and I'm just asking them questions like, have you spoken to your mortgage broker about your borrowing capacity inside super? Have you set up an SMSF? Have you rolled over funds from your existing, retail or public offer super fund? And I'm like, if you're not ready now, then you've got a slim to none chance. Like I spend the majority of my week searching and sourcing and for clients, active property, and the risk that you run as a result of trying to get under contract in the next 4 weeks. We've got a month exactly. So today's the 10th of July for transparency. 10th of August, the ban will kick in. So you've got a month to get under contract. So the risk is that you won't find the property that's fit for purpose within that time frame, and you'll just buy anything. You say, that'll do because I need to get under contract. And so that FOMO can be to your detriment because you just, quick, I got to buy something within the time frame.
Absolutely. And then also the flip side of that, playing devil's advocate, is if you don't, what does it look like you missed the boat to buy the property? So you don't know what the outcome would look like, because what if that property is actually a good asset that you bought as well? So again, it's a tough one, and I don't like what the government should have done. Should have at least give us a leeway. I agree to some degree the perspective why they've done it, but at the same token, they should have given it enough time for people. At the end result is really clients. They're the ones that can be affected by this because they're rushing.
Yeah,
right?
yeah.
So, yeah.
I think you're right. Like, if we did have to have a legislation like this, one thing I would probably do differently is to provide a little bit more time frame, because realistically we were given 45 days, and that, if anything, have forced people into potentially making a bad decision. And let's say if you gave people, 6 months, then you could really take good assessment to ensure that, yes, this potential investment strategy meets my financial situation, matches my goals, I'm buying in the right entity, I've sought out advice. But, now that we have such a short time frame, people are just like, quick, open up an SMSF, borrow, here's my pay slips, whatever I can borrow, and buy me something, and then potentially put themselves in a worse situation as a result.
I'm really trying to understand when something is proposed or changes to be made, really trying to understand what's the reason behind it. Right? And I get the reason behind it, but the time frame, I don't get it. There's no time frame or within the next 6 months that can shift that. I just didn't get why there's a 45 days. That part I don't get.
Yeah. Let's stay away from the political side of it. What about other entities? So look, I'm seeing a lot of overnight experts, propose into different entities like, you got to buy in a company now with A, B, and C shares, and company A fits into bucket B, and this sort of stuff. Like, is there a right entity, or is there a case-by-case basis that you need to consider?
It's a case basis, but at the same token, in a self-managed super fund, you can still gear up to particular entities. It's a little bit complicated. So self-managed super fund can be a shareholder for, but it's a unit trust. And the unit trust is buying, I don't know, a few houses and development or things of that nature, or one single acquirable asset. Self-managed super fund can still invest in that.
Oh.
Right? Technically speaking, and that trust entity itself can borrow into residentials and things. That, again, you seek proper advice. If it warrants to do that, you can still do that. That doesn't change. That's always been there. And obviously, a commercial lending side of it, but it's always been there. It hasn't changed. Going back to your question in terms of acquiring assets in the personal name, a trust, bucket A, company A, put it here and there. It all going to be depends on what we're trying to do, really, at the end of the day. Right? Some accountants that I've spoken to, they're kind of seeing that uptake of inquiries around it as well. And again, the purpose is, what's the purpose? Is it, are you retiring? Are you exiting the business? Or what is it that you're trying to achieve? If they say, well, I want to save tax, that's really not a goal. You got to deep dive, well, what else are you trying to do? At the outcome of that on the onset as well. So the answer to your question is, you have to break it down and see what's going to be appropriate for those. And you look at it, okay, you're going to buy an trust, this is what it looks like. By personally, this is what it looks like. Besides tax, what else are you planning to do around it? Then you get the outcome.
Yeah. I think a lot of people are putting the strategy first or not even getting the strategy correct, because some people's strategy is to avoid tax at all costs. But I think that the strategy needs to be first, or the process needs to be first, that it needs to be more goal orientated. And to your point, like, what is the goal? Why are we doing this for? Is it because you want to retire? You want to sell the company, or, however, whatever, and then from there we go, okay, this is the goal, that's the strategy, and this is the most appropriate entity for that strategy. Therefore, this is what we're doing. I think I see it a lot, especially in property. They go for the property first, and they
Exciting.
yeah, because it's exciting to buy things, but no, there's about 4 or 5 steps before that. Like, what's the purpose of this goal? Is it to create passive income? Is it to achieve capital growth? Or even if we articulate it into other terms, like I said to my clients, well, why are we buying property? Like, do you want to use property to buy your first home? Do you want to use property to help your children build wealth for their future? Do you want to buy property to be able to afford a certain lifestyle in retirement? Like, those are the type of goals that people should be thinking about. Not, I get a lot of like just really stereotypical ambiguous goals like capital growth or passive income. Like, these are just buzzwords that are out there, and they're not very articulate whatsoever. So
when you explain it in a way how you go to value and not just the asset itself, how that links to the overall goal, I think they're appreciative of that in terms of okay, hold on, now you think beyond this. Absolutely.
Yeah. Because I tell people, like, you might be in love with buying property, but property might not be the best fit for you. And I think I've even referred you a couple of clients. I'm like, I don't think that this person should buy property. Hey, Jack, have a word with them. If property is appropriate, if you give me the go ahead, then I'm more than happy to buy them property. But until then, I don't think that they should be buying property. So look, yeah, I'm probably the worst property salesman ever, because I just don't think it's fit for everybody. And any investment needs to be fit for purpose.
I think you probably look at it, Johnny, in a way that there's a K factor there that you'd look at. And yes, I get it. We also want to feed our family. We run a business, but in the same token, a detriment of someone doing the wrong thing. So it's good. That's why partner with you in a sense that there's a key value there that we stick by the integrities there to make sure the clients are looked after. So no,
Yeah. No, nice. Yeah, very good. When it does come to strategy, how important is strategy in terms of the overall financial plan to achieving, a person's goal? And what sort of process do you go through personally to help assess what strategy is fit for that particular goal?
Yeah, I call it a stress test. It's really just challenging the belief of a particular client or business. As I always say this to clients, I'm not here to say what you want to hear. I'm here to direct you or guide you, give you advice what I believe would be best in your situation based on what you want to achieve. But by starting with that and just really challenging, they might say, oh, Jack, I want to do this and do that. Well, is it realistic to get to that destination without doing this or doing that? Right? And obviously, we're talking about property today. Is it the topic that we're alluding to? Well, I always say, why do you want to buy that property? That's it. I got one guy that said, oh, look at this industrial property. I said, because it's nearby. I said, yeah, given it's near your house, what's the reason behind it? I mean, can you give me an insight? What's the logic behind it?
Mm.
And more often than not, well, I don't know. It just looks good and it's nearby.
They think they're going to drive past it every day and, check on everything, make sure the tenant's treating it well, and just...
So, dictating as well as sharing your personal experience helps. Right? Nice. Yeah, I go say to them, well, I've got a property in Queensland in Robina, which I said to them, which I've never seen. Right? Well, I've seen the pictures. I joke around. I've seen the pictures. I bought it for 316 back in the day. Maybe it's 700 something. So I explained that to them that this is an investment decision purely, or is it not?
Yep.
And they're determining that, okay, you're buying something in the South Coast because part of the plan is to retire. Okay, I get it. Okay, so what are we going to do now?
Yeah.
So it is quite interesting. And then obviously, this, because I can see the property, drive past it. I can see what the tenant's doing.
There's a ton of emotional biases like that. And I find first-home buyers are probably the biggest culprits, I think, because they have like multiple goals. But maybe first-home buyers, also wealth accumulators, they do that bit, like people typically in their 40s and early 50s. And they're probably prone to the most emotional mistakes because people think, I want to buy an investment property and then I'm going to live in it in 5 years. Or to your point, I want to buy an investment property that I can retire in one day. And I said, well, no, it's not an investment. That's just a property that you're buying. That's just a toy or something, because who says that buying the property now will mean that the value is going to increase or you're going to save money by buying it now? You can invest in anything and afford that property, or even you could invest in something else and afford something better because you've purchased the right asset that meets your goal for that time frame. Buying property now because you plan to live in it one day isn't an investment. It's it's a future purchase, and you're committing the majority of your money to an asset now in the hopes that it will grow in value. But you've taken no research, no due diligence, no analysis around, okay, all these leading indicators and cash flow line up. You've just got blinkers on, and you're thinking about your future self, but you're not really thinking about how that sits in terms of an investment aspect.
Absolutely. It's all about educating your clients at the end of the day and see what that really looks. No matter how tough that conversation may be, my job is to make sure you fully understand this is not what it's supposed to do. Clearly, this is for a lifestyle. It's not financial. If this the party over the head. Oh, okay. The financial outcome is this. You don't care what the color of the windows are. Oh, well, maybe not. So that if it's pink or yellow.
To a degree, yeah. But yeah, I've had people reject property because of the curtains. I'm like, hey, like worst case you can change the curtains, or another one is the feng shui of the house. I've heard that a couple of times. Yeah, feng feng shui is pretty important apparently. Yeah. I wanted to lastly touch on around capital gains tax. So capital gains tax has changed, and there's a few different impacts, predominantly so for the older generation that have assets pre-1985, and then you've got post-1985 that were typically under the 50% rule, and now you've got an indexation method that will apply for assets, I believe, from 1 July 2027. So given those three cohorts, pre-85, post-85, and then post-2027, what are some of the things that people need to think about in terms of assessing, when they sell an asset, let alone investment property?
Well, two things to that is because it goes back to the time frame. For example, for retirees, I've got, we're kind of expedited now. 1st of July now is our goal for next year because we've got properties to sell. Because we don't want to lose the 50% discount.
Yeah.
So good and bad in a sense that we now have to shift the plan because of what's happened. It's good to some degree. It kind of pushes the pre-retirees not to retire maybe a bit earlier, which is good to some. In some cases, people that's holding these assets has only bought it, I don't know, the last 5 years or even less than that, they're going to get caught up with that rule. But the same token is when they exit at a particular point in time, because if you sell it, say in 2030, you still get the capital gains tax calculation after 1st July next year, and then that index of 30%. So again, you have to do the numbers and see what it looks like. And then you adapt to the shift of, okay, well, do we plan around this now or do we leave it for the time being? But the key thing is that you start to look at it whether it's now or later on, because it does have an impact if you calculate it. Now, if it's a live scenario, like there's a live property, you can actually calculate what this all looks for you from a capital gains tax perspective, right? Even after 1st of July next year. So critically start to plan it now and then talk to the advisors, accountants, whoever that you need to do and look at those options.
Yeah.
Just it can be detrimental later on as well. So, but going back to those cohorts that what properties are 1985 owners and so on and so forth, yes, it makes sense typically to sell before next year.
Yeah.
But the question is, what do you do with the money?
Yeah.
That's another conversation.
That's your next problem, I guess. Yeah. So, yeah, look, I tell people all the time, like it's easy to get into property, but it's hard to get out. Like any sales agent is going to take your money. You know what I mean? But you have to sort of consider your exit plan and all the costs associated with getting out of property. And one of those exit costs is capital gains tax. Capital gains tax, sales agent commissions, legal fees, mortgage discharge costs, etc. So
That when I do the planning, what it looks like, and now I have to factor in from 1st of July what it would look like and see if it's worth holding it as well sometimes.
Yeah, and that was what I was going to say. Like people are going to come to a decision now. Am I beneficial? Is it more of a benefit to sell now, or if I don't sell now, how long do I need to hold it for so that I net that goal amount? So if your goal amount is arbitrary $1 million and it's going to cost 3% to exit, including capital gains and sales costs and all that sort of stuff, or no, you're going to wait until it hits $1,030,000 because then you're left with that net goal amount.
Yeah, you're right, because if the capital growth kind of exceeds that, it offsets the capital gains that you would have had discount.
Yeah.
So you have to look at the numbers and see what it all looks, right?
Yeah.
Now, if it's a live property, you can now actually estimate what the average capital growth of the existing property, which we can do. 1st in July, like you said, arbitrage that versus if you didn't sell it, you retain it, and you just rely on the capital growth, what would it look like? Sometimes it can work. Again, the numbers.
Yeah, very good. Listen, Jack, it's always great talking to you. If anybody has any questions around financial advice or anything that we talked about today, how's the best way to get in touch?
Just email or call me directly.
Yeah, awesome. Sounds great. Thank you so much for your time. I really appreciate it.
Have a great day, everyone.
Okay, done.
Stop recording, yeah? Cool.
Yeah.